Distributors track a collaborator's contributions over time and rewards them based on that performance after a set period of time has passed. Unlike programs, distributors do not trigger when someone purchases something on your site. Instead, distributors track aggregate data over time and then use that data to create obligations on a set schedule. So distributors allow you to set up systems that track performance and reward collaborators based on their historical performance instead of what they've done recently. Since they are not bound to a transaction, they allow you to create several different incentive structures that are not possible with a program alone. For example, you could use a distributor for creating a profit share program, where collaborators are paid a share of sales based on their performance. An example of this could be a platform that pays their course creators based on how many members complete that creator's course. Another common use case for a distributor is a bonus program. A bonus program pays the top performing collaborators a bonus. For example, you could pay a bonus to the affiliate who generated the most sales last month, or pay a blogger for generating the most visits to their content last month. Setting up a distributor is very similar to setting up a program. Let's get into how to do that now. In our example, we're going to set up a profit share program for an education site that has multiple course creators, and the access to the content is handled using a membership fee instead of charging directly for the courses itself. Each course creator will earn a share of the profits based on how many members consume their course content. The members who have the most members that consume their content gets the largest share of the pool. Let me show you what I mean. So here I have my commission pay calculator that helps kind of explain how these different program structures work. So in our case, we're going to use a shared pool. And let's say we have 10 course creators and we're paying them 25% or the pool of money that's available is 25%. So 25% of our profits from the memberships we are dedicating to all of our course creators as a bonus. And let's say we earned $10,000 in a month from our memberships. So we're going to pay out 25% of that $10,000 and evenly distribute it among all 10 of our course creators. Now, normally we would just pay each of them an equal amount of money, $250 each. That is a equally shared pool. So everybody just gets their own share. They each get 10% of that 25%, which is 2.5%, which is $250. Now, what if we wanted to do this in a way where we rewarded the top performing course creators for making sure that our site, our customers are being retained, right? They are staying, they're not churning, and they're being engaged, right? So in order for us to be able to reward that behavior, we want to take a share, make sure that the share is distributed based on performance. So we would add what we call a performance bias. So we would, as this goes up, right, you can see that it increases and it decreases quite a bit more. So just in this scenario, even just adding a little bit more of a bias here, you can see that the top payee is earning $722 and the bottom payee is earning $2.88. So in this scenario, it would basically be that the majority of the course content that is being viewed by your members is by probably these top 4 people. And then all these other people these ones have a few people, and then these people probably are laggards and they're not really contributing nearly as much compared to the other people. So the way this works is, of course, everybody is being compared to each other, and it's based on everybody's performance relative to one another. That's how a performance shared pool works. So now that we've explained that, let's go ahead and put this distribution together. I'm going to show you how we are able to actually measure who's the top payee and who's the bottom payee and how all of that works with the distributor. All right, so we are going to go into Siren and go to distributors right here. And if you're from the dashboard, you can also just hover over Siren and click distributors directly. Once we're in here, you can actually see I already have one set up. So I'm going to go ahead and click on that and just show you how it works. And we'll just kind of go through it one by one. So of course, if you've remember seeing the programs, if you've seen how we create programs in Siren, it's very similar. So we're going to give the program a name. In our case, it's a membership performance program. The description, pays course creators based on performance. We're going to set the status to active. We're going to select our currency. We're going to set that revenue percentage to 25%, right? So just like in our example with that payment calculator, that payment was 25%, right? So this is actually the pool, right? How much of the revenue is available. So this is the pool of money that is going to be distributed to everybody. This is not how much money you're paying each individual contributor. This determines how much money is available in the pool from the time period that is set up on the schedule. So in this case, we're triggering this every month on the 25th. So that means that what's going to happen here is the distributor is going to take all of the income that comes in from the things that are valid and relevant to the distributor, and it's going to keep track of how much sales are generated, how much money is generated in those transactions from that time period. And then it's going to take 25% of that value, and it's going to say, here's how much money we can actually distribute. Here's how much money we can actually distribute to all of the collaborators that are a part of this distribution pool. So that's how that works. This is not a commission percentage or something like that. This is a revenue percentage, a share percentage that is available to your collaborators. Okay. From there, we're going to set a distribution schedule. You can set it once a year if you wanted to do an annual bonus. You can set a weekly bonus or a monthly. In my case, I'm going to set this to be a monthly bonus or a monthly distribution. Metric tracking events. These work a lot like engagement tracking events in programs. So basically, these are the things that have to happen that you're measuring, right? These are the things that you're measuring that your collaborators are doing or that are related to your collaborators that determine their performance and determine if they're eligible for the distribution and how much they can get from the distribution. So in our case, there's several of these. There's site visited, right? So this one works just like on programs. So an affiliate link, when it is, if a collaborator's affiliate link is used, it will use this. Same thing with blog post visited. So if a person is writing blog content on the site and anytime that their content is read or viewed, it'll use this. And of course, all these have a value, and I'll get to what that means in a second. Collaborator product sold. In this case, this is whenever a product that is owned by a collaborator is sold, it will track that and give credit for that. Coupon code used. Anytime a collaborator's coupon code is used, it will track this right here. So if you wanted to create a bonus program for affiliates, for example, where maybe if they sell enough revenue in or enough cars or enough of some kind of product, whatever it is, you could give them an extra bonus on top of it. You could use coupon code used and site visited to keep track of how many sales they've done throughout the month so that you can figure out if they're eligible for a bonus or not. Course completed and lesson completed. These are actually LMS specific. So in this case, this is for course creators. So if a student completes their course, we're going to give them credit, or if a lesson is completed, we're going to give them credit. Now here there's this value, and whenever you check these, you see that value shows up on any of these. So what value is it's the number of points that the distributor credits whenever that thing happens. So in addition to the revenue pool that is being tracked by the distributor, how much money is being pulled up over that month, the distributor also tracks how many points each collaborator earns from these different metrics. So, and the point value determines how valuable doing that specific thing is. So in our case, we have course completed is worth 10 points and lesson completed is worth 1 point. So if you have a course that has, a series of lessons, we're going to give a little bit of credit every time somebody completes one of your lessons, but we're going to give a lot of credit if they actually complete the entire course. So in other words, 1 point for every lesson and 10 points for every course. So then at the end of the month, whenever all of the lessons are completed and the courses completed and all of those things, it'll tally up those totals and it would use that to determine the revenue share, right? This is how we're measuring the performance of these collaborators. The incentive structure, this determines how we pay out, right? So in this case, it would be, is there a bias? Is it even distribution? How do we pay for the incentive structure? This is what determines who of the collaborators in this distribution gets paid. So there's shared engagement pool, performance weighted pool, and top score wins. Shared engagement pool in that case would be an even distribution. So any collaborator that has earned any points at all would get credit. If they earned 0 points, they wouldn't get any money. But if they earned some points, they would get a cut. So that's a shared engagement pool. In the case of performance weighted pool, it would work exactly like the shared engagement pool. The only difference is it would apply that bias based on everybody's scores. So the top scores, so the people who have done the most, earned the most points from the different metrics up above, would be at the top of the list, and the people who earn the least would be at the bottom of the list. And then top score wins. This one will pay one collaborator, not all of them. It will give them the whole entire cut of the distribution to the person who earned the most points. So you can use this for competitive opportunities where you're saying, the top performer is going to get, an extra 10% bonus or something like that. In that case, that would be roughly equal to the bias being basically non-existent. It would be basically one person would get the full 2,500 and everybody else would get nothing. Okay. So in our case, we want to use a performance weighted pool because we are paying based on performance of these memberships. Include in commission pool. So what this section is this section talks about what parts of a transaction is going to be tracked for the commission pool itself. So what this determines is what parts of the transaction are actually eligible. So if maybe for example, you are doing a bonus, a one-time bonus for the top scorer, the one affiliate who sells the most of a specific product out of all of the affiliates is going to get a $300 bonus or something along those lines, right? In that case, you would leverage this allows you to filter out to only include those specific items in the pool to make sure that it's only tracking those specific things with those things in the transaction. Since we're using a revenue percentage, since we're using revenue percentage, sorry, I realized I didn't switch the camera over. Since we're using revenue percentage here, it's going to basically calculate the total value of the transaction based on these filters. And that's going to be how it knows how much money is eligible for this distribution. So in our case, this is very similar in how programs work whenever you're creating a program down here, where it's determining what piece of the transactions are relevant to this program, or in this case, what are relevant to this distribution. So in our case, we want to account for discounts because of course we don't want to pay out, we want to make sure that the value of a discount is being subtracted from the total because we don't want to pay the total value of a transaction. So basically what this means is if you had a $125 transaction and there was a $25 discount, you only want to pay out $100. You don't want to pay what the value was originally at $125. If you leave this unchecked, it would be $125. But if it was checked, it's going to account for that $25 discount and only distribute the $100 value that was actually charged. You're going to also check fees because some memberships and things like that also include setup fees and things like that. So for example, I've seen a lot of hosting companies or service companies, they'll do a setup fee where they'll charge a one-time like $500 fee to go in and set up the system or do whatever. And then after that, there's a monthly fee that happens thereafter. So this would make it to where that fee is being accounted for in the subscription, in the distribution. So if you want to account for that, then this should definitely be checked. Obviously, in the case of this specific program, it's possible that maybe you don't want to account for that. Maybe you only want to account for the monthly revenue. It just depends on how you want to handle that. Next up is line items. So whenever you check line items, you'll see it adds a few other things. So line items are the actual stuff that people are buying. So the membership, in this case, it would be the membership itself. The cool thing about line items is you can actually filter what categories, what SKUs, and what product types are relevant to this commission pool. So let's say, for example, you only wanted to account for, you only wanted to pool up money related to a specific product. Maybe you were only working with, let's say you're selling shorts in some kind of like late fall transaction where it's the person who sold the most shorts in the month of September is going to get a 25% share of bonus or something like that. You could say, shorts, or whatever the name of the SKU is here, and it will only account for the shorts in that setup. Same thing with categories. Basically, you can add any kind of category. So this could be maybe all pants and all shorts. Those categories, would are the only line items that would apply to this distribution. And then with any of these types, so this would apply to both products and subscriptions. In our case, we really only want this to apply to subscriptions because for us, memberships are only going to apply to recurring revenue, not necessarily things that are being bought on a one-off basis. So we're going to set that to subscriptions instead. Shipping and taxes, you almost never want to leave checked because you probably don't want to pay out commissions on shipping, and you probably don't want to pay out commissions on taxes. Okay, so that is basically how distributors work. So what this will do now is whenever we add collaborators to this over the course of the month, the distributor will quietly track all of those things. And then at the end of the month on the 25th, it will automatically create the obligations that we need to handle how much we owe everybody and who we need to pay.